Imagine waking up tomorrow and discovering that every dollar you saved over the last 20 years had quietly lost half its power, not because of a stock market crash, not because you made a bad investment, but because the people who run the global financial system, central banks, made decisions you never saw, never voted for, and never even understood. That sounds dramatic, almost like a conspiracy. But it isn't, it's policy, and it has been happening in slow motion for over a century. Today we are diving into a conflict almost nobody talks about, the silent war between central banks and your savings. This isn't a lecture. This is a story of power, quiet manipulation, and a system designed to look boring so nobody ever questions it. Let's start with a simple question. Why do people save money? For safety, for retirement, for emergencies. Because the future feels less frightening if we have some numbers in a bank account. But what if the very people responsible for protecting the value of your money have been doing the opposite? Right now, central banks across the world are celebrating that inflation is cooling. But think about this. If prices jump 20% and then stop rising, that's not a victory. Your loss stays locked in forever. A gallon of milk doesn't go back to what it used to cost. Your savings don't magically grow to match. Cooling inflation isn't healing. It's freezing the damage in place, and that is exactly how the system works. To understand why, we need to step back in time. It's 1913. The Federal Reserve is created in the United States. Its job looks harmless: keep prices stable, keep unemployment low, and make sure banks don't panic. But here's the twist. From the moment central banks were born, the value of savings began to die. The US dollar today has only about 3% of the purchasing power it had in 1913, not 30%, 3. That means a $1,913 could buy more than $30 can buy today. You didn't lose that purchasing power because you spent badly. It evaporated because the system needed growth, and growth demanded inflation. See, inflation isn't an accident. It is a target. Most central banks openly aim to destroy around 2% of your money every year. It sounds small, but 2% every year for decades is enormous. A $10,000 saving protected under your mattress would shrink to around $6,720 years even if you never touched it. Imagine you put that same $10,000 into a savings account returning 1% interest. Congratulations, you just lost money more slowly. This raises a disturbing question. If inflation hurts savers, why do central banks want it? Because modern governments run on debt. And debt hates strong money. If inflation rises, debt becomes cheaper to pay back. If inflation falls, debt becomes expensive. So governments quietly prefer your money getting weaker. Your dollars erode, so theirs survive. That's the quiet conflict. And it gets deeper. Take 2008. A global financial crisis hits. Banks are collapsing. Markets are burning. So the US Federal Reserve begins a program called quantitative easing. It sounds like a yoga stretch. What it actually did was print trillions of dollars electronically and pump them directly into the financial system. We were told this was to stimulate recovery. But let's look at who benefited between 2008 and 2020. US house prices nearly doubled. Stock markets tripled. Corporate valuations exploded. Meanwhile, wages crawled forward at the speed of a tired snail. Savings? Destroyed. If you saved $20,000 in the bank after the crisis and let it sit, inflation destroyed about a quarter of its real value, while the people who owned assets watched wealth rain down like confetti. That's not an accident. That's design. Central banks don't reward savers. They reward borrowers. Why? Because borrowing fuels spending, spending fuels growth, growth fuels political survival, saving slows the machine. That's why for over a decade, interest rates around the world were pushed close to zero. It was sold as help. In reality, it was punishment. If interest rates fall below inflation, saving money becomes financial self-harm. Think about the absurdity. You work your whole life believing the responsible thing is to save, but the financial system quietly punishes the responsible and celebrates the reckless. You save, you lose, you borrow, you win. That is the upside-down logic of the modern economy. And then came 2020, global pandemic, lockdowns, economic panic, central banks printed more money in 2 years than they did in the previous century. The results were predictable. Home prices shot up 40%. Food inflation exploded. Retirement plans collapsed. Your savings lost purchasing power at a rate not seen since the 1970s. And yet, the official message remained calm. This is temporary. Things will normalize. Did they? Inflation cooled, sure, but prices didn't fall. They just stopped rising as quickly. You don't get your savings back. You don't get purchasing power returned. There is no refund desk for inflation. This is why many economists quietly call inflation the most powerful tax in history. A tax that requires no vote, no debate, no legislation. It simply happens, and we accept it. Let's look at the numbers. From 2020 to 2023, the average American household lost roughly 36% of its purchasing power. European households lost between 20% and 30%. Those numbers are catastrophic. But because they happen slowly, monthly, invisibly, most people hardly noticed until they tried to buy groceries or rent or medicine and realized the world had changed. Here's the deeper truth. Central banks were created to stabilize economies, but over time they became the economy. Their decisions dictate whether you can afford a home, whether your salary means anything, whether your retirement has a future. And yet most people can't name a single person running their central bank. Think about that. You know, your local Mayor, you know the president, but the person deciding interest rates? The person controlling inflation targets? The person shaping the value of every dollar you own? That person works behind closed doors and you never voted for them. Now, to be fair, inflation isn't evil by design. Without it, economies could implode into paralysis. Businesses would stop borrowing. Investment would collapse. Governments wouldn't function. The irony is overwhelming. Inflation destroys your savings, but no inflation destroys everything else. So central banks walk a razor blade. They want inflation just low enough to keep the public calm, but high enough to keep debt manageable, which means your savings are a necessary casualty. Let's break it down bluntly. Central banks want the economy growing. Growing economies want spending. Spending requires people to feel like saving is pointless, so savings are quietly sacrificed to protect the machine. Your loss is built into the blueprint, and here comes the final twist. We're entering a new phase: digital currencies, digital payment rails, central bank digital currency proposals. If this happens, the old war against your savings becomes child's play. With programmable money, central banks could create negative interest rates. Imagine being charged to hold money. They could expire currency over time, forcing spending. They could adjust your purchasing power in real time. That is no longer science fiction. It's being tested right now, in China, in the EU, in pilot programs around the world. If inflation was a silent weapon, programmable money is a guided missile. So what do you do with this information? This isn't a call to panic. It's an invitation to awareness, because once you understand the system, something strange happens. The world you live in stops feeling random. Prices rising aren't a glitch. They're a strategy. Savings shrinking aren't a mistake. They're a feature. Central banks aren't fighting inflation, they're shaping it. They aren't protecting your savings, they're taxing them invisibly. Some people call this manipulation, others call it survival economics. Both may be true, but it leaves us with a haunting question. If the value of money is designed to fall, and central banks need it to fall to keep nations alive, then what does saving actually mean anymore? Is saving money building a future, or funding the system that melts it away? We've spent over a century trying to answer that, and maybe the real answer is unsettling. The war between central banks and your savings never ends, because the moment it ends, the economy as we know it does too. So here's the thought I'll leave you with. If the people who control money don't want you to save it, what are you really saving for? And what happens when the public finally realizes the value in their bank accounts was never guaranteed? It was negotiated. The system continues. The silence continues, and the war goes on until the world decides to ask why.